Emily, it's been too long, so it's really good to see you. Just to start on the cryptocurrency Coinbase Bitcoin market, some were calling yesterday a liquidity event. What did you notice about sort of the money flows? Like, what's the Venn diagram of people who are buying Tesla and Bitcoin and Coinbase?
So, Alex, thanks for having me. It definitely has been too long. It's great to be with you. When we look at this phenomenon, it's really going to be interesting to see how this proliferates into the indices. So, if you think about areas like technology and consumer discretionary now being more driven by, frankly, price fluctuations in Bitcoin, whether it's via Tesla or now via Coinbase, and we'll see how that gets reflected in the indices, investors are going to need to make a decision here. If you liked tech and consumer discretionary before, you got to make that call about whether you want to have this element of Bitcoin reflected in your positioning. So it's going to be a big deal as far as how that plays out, and it's going to be more important than ever, I think, for investors to just really understand what they own as far as these major sectors in the S&P 500.
And that kind of leads me to the price action today, where you get these truly awesome economic data indicators here, and then the Nasdaq is up, then the recovery sectors, et cetera, is down. Even the high flyers like a Coinbase not really doing that much. What does that tell us about what the market is actually pricing in right now?
Yeah, I think the great performance out of Nasdaq and technology really has to do with the fact that we've seen yields on the 10-year Treasury actually falling a bit after this data to below 160. That is a huge head scratcher this morning in a lot of ways. And this economic data for March is almost breathtaking. You think about the ISM at the highest level since 1983. The fact that we just added 1 million jobs to the economy in March, if you count the last 2-month revisions. Of course, this blowout retail sales number this morning at 9.8% month over month. Industrial production just keeps coming. And it's almost as if it just can't get any better than this, because at the same time, you have inflationary pressures that are remaining contained. You look at CPI over the last 3 months, and it's coming in still below 2% at 1.9%. So awesome economic data, inflationary pressures remain contained, and you're seeing this nice favorable reaction from the stock market. The bond market might be sniffing out a more normalized economic environment as we head forward. And the other element to think about here is that we have to remember that the US Treasury market is a global market. And we may potentially be looking at a situation in which we've got buyers from other parts of the world here coming in. Risks are emerging. We talked about what's going on in Russia. Risks are emerging in areas like China. We're seeing yields come down as far as Chinese sovereign debt. That is bringing in foreign buyers here into the US. So a few different things to think about there.
I also wondered, too, if we pair with what Jay Powell talked about yesterday in terms of the sequencing, which was the first sort of rough sketch of how the Fed may eventually exit, saying we will reach a time at which we will taper asset purchases when we've made substantial further progress towards our goals. But that would in all likelihood be well before the time we consider raising rates. He pushed it out maybe like 2024 is where we're seeing something like that. Doesn't know how they're going to sell actively, but just let them roll off. Like, I wonder how much of that is a reaction in the market as well. Like, yeah, okay, we can go buy a lot of high flying tech because we're going to have a lot of money slashing around, but Fed's not doing anything anytime soon.
Yeah, I think that this kind of disagreement that we're seeing between the bond market and the Fed is starting to come together a little bit. We're having a little tete-a-tete here. And what was happening, what has been happening is that the bond market has been pricing in growth and inflation, as we all know, where the Fed has said, look, we're not going to get off the zero bound for quite some time. We're not going to taper. We're not even thinking about tapering QE, and then the bond market's been calling the Fed out. In fact, if you look at what's priced in as far as Fed rate hikes, the bond market's looking for 1 next year and then 2 in 2023, whereas we know the Fed's dot plot is suggesting none. So really the way that we think about it is if you've been positioned for that, or if you've wanted to benefit from potentially more inflation or more growth, you've got to exceed even what the bond market was pricing in, which was much more than the Fed. So we were taking the other side of that. We wanted to continue to embrace high quality bonds. We recognize that the return potential is very low in treasuries, but the way that we had been looking at it over the last quarter was for a more attractive entry point here. And we've seen a lot of pain for fixed income investors over the last quarter or so. We had a drawdown of almost 4% in the bar cap ag, which is about as bad as it gets for fixed income investors. And we had been looking opportunistically at this as a reminder that you want to own bonds that act like bonds in a portfolio to diversify from potential equity market risk.